Welcome, everyone. Today, we're going to conduct a really deep dive into one of the most fundamental tools in all of business financing, the note payable. Now, our goal here isn't just to memorize accounting entries, it's to truly understand how this single liability, this one piece of paper, can actually shape the entire future of an organization. So let's start with our roadmap for the day. Here's exactly what we're going to cover to make sure you walk away from this with a solid, practical, and robust understanding of this topic. We'll start with the definition, then we'll break down the components of a note. After that, we'll apply everything to a real-world case study, walk through the accounting, and finally, and this is the most important part, we'll talk about its strategic implications and some of the common mistakes to avoid. But before we get into the mechanics, let's just step back and think about a core challenge that every single business leader faces. It doesn't matter if you're a startup in a garage or a massive global corporation. How do you actually get the money you need? How do you fund that big expansion, or buy that critical piece of equipment, or even just make payroll when things are a little tight? It's a fundamental question. And one of the most common answers to that question is something called a note payable. So what is it? Well, at its absolute core, you can think of it as a formal, legally binding IOU. It's a written contract where one party promises to pay another party a specific sum of money by a specific future date. And, of course, there's almost always a cost to borrowing that money, which we call interest.
Okay, so we have our textbook definition, but let's move beyond that. Let's really dig into the what and the why here. As a manager, why would you choose this specific method of financing over, say, getting investors or just saving up? That's the key question.
And here is where it gets really strategic. You see, businesses use this type of debt as a powerful tool. Think about it for a second. If a company needs cash, it really has two primary options. It can sell off pieces of ownership, that's called equity financing, or it can borrow money, which is debt financing. The huge advantage of a note payable is that the company gets the capital it needs to grow without the original owners having to give up any control or a slice of their future profits. For a founder, that is absolutely crucial.
All right, to truly understand how these notes payable work, and more importantly, how to analyze them, we have to dissect one. We need to break it down into its core components. Think of these as the DNA of the loan agreement.
These four elements right here form the legal and financial backbone of the entire agreement. First, you have the principal. That's straightforward. It's the lump sum you borrowed. Next, the interest rate. That's the lender's fee, the cost of using their money. The maturity date is the finish line, the day the final payment is due. And then we have covenants. Now pay very close attention to this one. Covenants are the rules of the road that the borrower has to follow. For example, a covenant might say you can't take on any more debt or that you must maintain certain financial ratios. Breaking a covenant is a very, very big deal. The lender could have the right to demand immediate repayment of the entire loan. So for a manager, ignoring covenants is a recipe for disaster. Theory is important, but application is everything. So let's make all of this tangible. We're going to walk through a case study to see how these concepts actually apply in the real world. Because remember, in business, it's the managers making decisions, not just numbers on a spreadsheet. So let's meet our company, Apex Innovations. They're a tech company, and they're facing a great problem to have. Their product is a hit. Demand is growing so fast that they can't keep up. Their critical issue is a bottleneck in production. To grow, they need to purchase new manufacturing equipment. The only problem? It costs $50,000, and they don't have that cash sitting in the bank. So we're going to follow Apex through these four critical steps. And I want you to see this not just as an accounting process, but as the entire life cycle of a major business decision from a manager's perspective. It starts with identifying the need, then negotiating the best possible terms, then recording it correctly, and finally, the long-term job of managing the repayments and staying compliant with those all-important covenants. All right, now for the mechanics. As a future business leader, you absolutely have to speak the language of business, and that language is accounting. So let's walk through, step by step, the logic of how Apex will record this new liability on its financial statements. Now, this slide perfectly illustrates the fundamental accounting equation in action. Assets must always equal liabilities plus equity. Look at the before column. We have $100,000 in assets balanced by $20,000 in liabilities and $80,000 in equity. Now look what happens after the note. Assets go up by $50,000, and look, liabilities also go up by $50,000. Equity is untouched. Both sides of the equation increase by the exact same amount, keeping everything in perfect balance. It's the foundation of double-entry bookkeeping. So what really happened here? Well, the company's cash account, which is an asset, increased by $50,000.
But at the same exact time, its notes payable account, a liability, also increased by $50,000. So yes, Apex has more cash, which is good, but it also has a new obligation, a new debt to repay. It's a classic business trade-off.
And for those of us tracking the debits and credits, here's the journal entry that actually makes that change on the balance sheet happen. We debit the cash account to show an increase in an asset, and we credit the notes payable account to show an increase in a liability. It seems like a simple entry, but this is the official first step in recording the company's new obligation on its books.
Okay, so we've got the accounting down, but now let's talk about the so what of all this. Because the impact of this note payable extends far, far beyond that initial journal entry. It cuts right to the heart of strategic decision-making for the company.
And this chart illustrates the real-world consequence brilliantly. The balance sheet might look stronger because assets went up, but the cash flow statement tells a very different and arguably more important story. Every single month now, Apex has a new bill to pay, a $1,500 loan payment. That's $1,500 that is no longer available for anything else, hiring new people, marketing, research, and development. Their operational flexibility has just decreased.
This right here is the critical distinction that separates a bookkeeper from a strategic financial leader. You have to learn to think in terms of cash flow impact. That $50,000 note is not just a static number on a balance sheet. It is an active claim on your company's future cash. It is a promise you made to send a portion of your future earnings out the door to a lender, instead of reinvesting it into your own growth.
So let me pose a question to you, the same way a board of directors would question the CFO. Given this new debt and the reduced cash flow, what key financial ratios should Apex's management now be watching? Obsessively. Well, you'd immediately start tracking liquidity ratios, like the current ratio, to make sure you can cover your short-term bills. You'd be watching your debt-to-equity ratio. And perhaps most importantly, you'd be looking at a ratio called times interest earned, which tells you if your operating profit is high enough to comfortably cover your new interest payments. These are no longer just academic exercises. For Apex, they've become vital signs of the company's financial health.
Finally, now that we've seen the full picture of how a note payable works and how it impacts the business, let's discuss some of the most common mistakes that students, and frankly, even new managers make when dealing with debt. Because knowing what not to do is often just as important as knowing what to do.
Please pay very close attention here because mastering these points can save you from making significant errors in your future careers. First, forgetting to accrue interest. You must record interest expense as it's incurred, not just when the cash payment is made. This is the matching principle in action. Second, misclassifying the note. The portion of the principal due within the next year is a current liability, not long-term. Getting that wrong gives a false sense of the company's short-term liquidity. Third, ignoring covenants. We've hit this hard, but it's a huge mistake. It's like signing a contract without reading the fine print. And finally, underestimating the total cash outflow. The loan isn't just for $50,000. It's for $50,000 plus all of the interest you'll pay over its entire life.
So, if there's one crucial point to take away from our discussion today, it's this. Understanding notes payable isn't just about memorizing debit and credit rules. It is about understanding the very strategic way a company chooses to finance its future and the solemn obligations that come with that choice.
And I'll leave you with one final thought to ponder, which is really the essence of accounting for decision-making. You're now the CEO of Apex. You've taken on the debt, you've bought the new equipment. Now what? What is your next strategic move? How are you going to ensure that this new debt becomes a catalyst for explosive growth and not a long-term burden that slowly drains the company's cash? How will you measure the return on this investment? That question. That's where accounting stops being about recording the past and starts becoming the tool you use to build the future.